Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 28th of September. My name is Fook Hien and I'm your host for the podcast. Your regular host, Daniel Lam, is currently traveling at the Asian Games where he is representing Hong Kong, China in chess. So I will be covering for him as the host for this podcast in the next few days. Now this week, we have seen some milestones reached in the FX market and in the bond market. Firstly, in the FX market, it's a mini milestone where the US dollar made a new high for the year, surpassing the high back in March. The US dollar or DXY index, it reached a new high for 2023 this week of 106.8. And a second milestone is in the bond market, which is a bigger milestone, where the US 10-year government bond yield closed above 4.5%, and this has not happened since October 2007. Essentially, US 10-year yields this week reached a 16-year high, back to the days of the global financial crisis. Now, the strength of the US dollar and bond yields are related, but for today, I will focus on the government bonds. Now, in a previous job, when I used to invest and trade in equities, we had a senior trader who liked to ask, is it a trend or is it range bound? Essentially, for any trader looking to make money, when they see a price trend, they have to decide whether the trend continues or is it range bound and will reverse and revert to the mean. In this case, the US 10-year bond yields have gone up because of fear of inflation and that rates will stay higher for longer. But we expect the US 10-year bond yields to reverse over a 12-month horizon. While the precise timing of a peak in yield may be debated and momentum may keep it supported for the next 3 months, history suggests that bond yields tend to peak around the same time as a peak in Fed policy rates. We believe inflation will come off, and we believe we are already at peak Fed rates, possibly one more hike. The high absolute level of yield now also offers a significant buffer against a further rise in yields. As an example, the yield on the US Treasury benchmark index would have to rise by over 0.75% before price losses start to outweigh the 12-month yield. Now, what does a rise of over 0.75% mean? A very simplistic way to quantify this is that 0.75% is equivalent to 3 rate hikes, and that is a lot. So over 0.75% is a big move over 12 months before you make a loss in the US Treasury benchmark index. Hence, we believe the risk reward is attractive and investors should seize the opportunity to lock in this yield in developed market government bonds. You can also have a strategy of averaging in over 3 months. That is all from me today. As always, if you enjoyed the podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.